Today, when housing's Ponzi pops. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance prop news with a distinctively Australian flavour. Like it or not, we're living in the midst of a wild housing Ponzi scheme, which is driven by low interest rates, bigger mortgages, and the quest by the RBA for the positive impacts of what they call the wealth effect. Have no doubt, this is not sustainable nor sensible, but is core policy of both the regulators and the government. The result is bigger debts, chasing higher prices, driving more debt and more borrowers, as I discussed in yesterday's post. And FOMO, the fear of missing out, is the underlying psychology harnessed by lenders, the real estate sector and the construction sector and beyond. The result is also higher levels of financial pressure on households, as I discussed in my live show on Tuesday, with mortgage stress, measured in cash flow terms, still very, very high. But the risks are rising and the questions are being asked about these policy settings, which, of course, are enticing people to buy. Now, Shane Wright at the SMH wrote this piece titled, "Tomorrow, the future being sold at our weekend auctions." And he said, it's a sign of how unhinged the national property market has become. When a friend who bought a house last Friday was told his new home had risen by $20,000 in value by the following Tuesday. He hadn't even got the keys to the place, but so separated from reality has the national parlour game that is bricks and mortar become that it is showing increasing similarities to a Ponzi scheme. Our love affair with housing has driven prices to record highs at a potentially huge cost to the nation's economic future. According to CoreLogic, Sydney's median house value has jumped by more than 15% since the start of the year, and it's now just shy of $1.2 million. And given the way prices are going up, it will have gone beyond that mark by the time you finish reading this article. It's not all that different in Melbourne, where the median value is now $908,000 after adding 9.4% since January the 1st. But it is not just our two largest property markets where the irrational exuberance is at play. House prices reached yet another record level due to the perfect storm of low interest rates and the improving economy. House values in Darwin, Canberra and Hobart have all climbed by more than 11% this year. And outside the capitals, values are up by almost 8% in regional New South Wales, nearly 7% in regional Tasmania, and 6% in regional Queensland over the past 3 months. It's being driven by a quadrilla of interrelated economic issues: record low interest rates, a glut of housing savings, due in part to a ban on Australians leaving for an overseas holiday, government support measures which have fed directly into prices and strong consumer confidence. Aiding and abetting the price surge is a tax system that encourages people to speculate on an asset class property which might provide a roof over our heads but does very little to boost national productivity. All this is happening in a country where population growth has fallen to its slowest rate since World War I. It's not being driven by rampant wages growth, which has slumped to a record low. All of these houses changing hands at auction days are being financed by debt that will eventually have to be repaid. Even as the figures are being released, Treasury Secretary Stephen Kennedy was telling us at an inquiry that the lift in house prices is likely to support above average growth in consumption. Household spending accounts for more than 60% of national economic activity. In other words, higher house prices will boost household consumption, which will grow the economy, which will then deliver higher house prices that will boost household consumption, which will grow the economy, etc., etc. All the focus at present is on the economy in the short term. Long-term worries, such as the generation of prospective house owners saddled with mortgages that would make a grand national champion bulk, are being pushed to the side. How else to explain federal and state government policies that are actively lifting prices? Somewhere, he says, this magical roundabout has to stop. The pain of that abrupt halt could dwarf the economic house price party currently being celebrated. So true. Short term, in line with the upcoming election, and a Ponzi scheme to boot. And now it's worth listening to the evidence which was given in Senate estimates this week. First, there was this from RBA Governor Guy Debelle, who clearly made the link between the desired wealth effect from higher house prices and RBA policy, despite the rising wealth inequality currently in play.
You recently acknowledged that record high house prices are being fueled by ultra-easy monetary policy and that this has distributional consequences. That was in your Shan Memorial lecture recently. Can I just start by saying, by distributional consequences, are you talking about wealth inequality there?
Well, that's one aspect. Yeah, I mean, if you've got a house, I mean, if you have a house and its price is rising, your wealth's going up. If you don't have a house, it's not.
Yep. So you are talking about wealth inequality. Thank you. You also said in that lecture that tools other than monetary policy should be used to address that increase in wealth inequality. What other policy tools are you talking about there?
Well, I talked a bit about this answering Senator Walsh earlier, but supply is one.
You talked about supply.
More housing.
Go ahead.
I mean, tax can have an impact. That's not in our hands. That's in your hands, yours collectively, at least.
I wish it was.
But
Australian people probably feel differently.
Yeah. Well, there are strong views on that. But I mean, in the end, affordable transport is another. I mean, it's interesting though. That's shifted a bit, obviously, over the last year or two, where where you live and work is a somewhat different proposition than it might have been 2 years ago. But having a supply of affordable, having transport able to get you, quickly to where your place of work is can help as well, and it sort of expands the potential supply of places that people might be willing to live and work. So, I mean, in the end, house prices are a function of supply and demand, I suppose. So stuff which affects the supply, we certainly have an influence on the demand side, as you've pointed out. But there's also the supply side upon which we do actually have some impact. As I said earlier, the rise in house prices is, along with obviously government incentives too, is actually engendering a very large rise in home building at the moment, right across the country. And I really mean right across the country. It's not just, it's regional Australia as well as the cities. And that is having an impact. So, but anything which works on the supply side is basically what I'm referring to.
Yeah.
I'm not an expert on the supply of housing, so.
No, that's okay, but the supply and demand of credit has an impact on house prices as well, doesn't it?
I don't dispute that, that's right.
Yep. So, as one of the previous senators touched on, your charter tasks you with contributing to the economic prosperity and the welfare of the people of Australia. So what effect is the increase in wealth inequality that has flowed, as you've acknowledged, from ultra-easy monetary policy having on the nation's prosperity and welfare, in your view?
So, as I pointed out in the aforementioned Shan lecture, in my mind at least, unemployment has a first-order effect on income inequality and lifetime income inequality and wealth inequality. And so that's the trade-off one aspect at least of the trade-off we're looking at. Yes, lower interest rates do lead to higher house prices, that is true. Higher interest rates lead to higher unemployment. That has a first-order impact on inequality as well, and that's the balancing act, trade-off, whatever, that we have to take account of, and that's not straightforward. But I do, as I mentioned in the Shan lecture, there is that consideration we have to take account of as well, and we are tasked with achieving full employment.
Yep. So about a third of Australians don't own their own home.
Yep.
And rising house prices equals rising rents. How does this increase in wealth inequality benefit that third of the country who aren't fortunate enough or rich enough to own their own home?
House price, yes, there is an impact on inequality. Part of, as people are wealthier, tend to spend more, which boosts economic activity in the country, which boosts employment, including for renters. The only other point I'd note, actually, in Sydney and in Melbourne still, rents are falling.
That's
so rents are rising and rising rapidly in some parts, particularly in some parts of regional Australia at the moment, which is as people have shifted to want to live there. So that's certainly true. But, a stronger economy where people are employed has an impact on renters as well. Then, as a number of people have pointed, to my mind, another way you can look at, what does matter in this calculus is whether your parents have a house. So yes, 1/3 of the people, 1/3 of people rent. A decently large chunk of that 1/3, but by no means all, have a parent or parents who own a house, and that, so there's an intergenerational aspect, I suppose, is what I'm saying to this as well, and that doesn't always end up equal as well. I would certainly acknowledge that, but I don't think it's quite as clear cut as saying, well, the 1/3 who are renting are, obviously worse off as a result of this. The fact that they have a job, which may not be immediately apparent from the settings of monetary policy, is something.
Okay, thanks, Dr. DeBell. So the first part of your answer there, would it be fair to say you're talking about the wealth effect?
Yes. So there is house prices do tend to get people to spend. We have had plenty of evidence of that.
So is the wealth? Sorry. So is the wealth effect basically just trickle down economics? Is that what it is? Those who don't directly benefit rely on an indirect flow from those who do directly benefit.
I'm not sure I'd call it trickle down economics. I'd also, sure the previous senators would like this. The circular flow of income is another way of putting it. That your spending is my income, right? That's actually more what I'd be talking about. What generates that spending is another question, but that's actually more what I'd be talking about. It's not, I don't think I'd quite put it that way. So if you look at who owns houses across the income distribution, that is not just, yes, the wealthy tend to have a high level of home ownership, but it's also pensioners tend to have a high level of home ownership as well. So it's not a straight, wealth and income, let me put it another way, wealth and income distribution don't line up one for one by any means.
All right. In answer to a question on notice I submitted last time, you've quoted a March 2019 RBA research paper to support basically the continued efficacy of the wealth effect. Mm-hmm. But isn't it true that a July 2019 RBA research paper, that's Price, Beckers and LaCava, reaches a very different conclusion, stating, consistent with international research, high levels of owner-occupier mortgage debt reduce household spending, including in more normal times. So given that 3 of your staff have found that, how can you be so certain about the efficacy of the wealth effect?
So the research that the Price, Beckers and LaCava piece says when households with high debt, when they get a shock, tend to reduce their spending by a little bit more. That effect is not larger than the overall or the macro effect of higher house prices on wealth. Those households which tend to have larger debt, the stuff that Gianni and Fiona and Benjamin looked at, said that if you have a house with more debt, then that can mean your spending is more sensitive to hits to your income. That's certainly true. That effect is not enough, nowhere near enough actually, to counteract the overall impact of the wealth effect of higher house prices on spending.
Okay, thanks, Dr. DeBell. I'll go back and read that paper again with that in mind. I know I'm short on time.
We are running short of time, so if you have a particular question you want to get on the record.
I do. Now I'm having to choose between my beloved questions, Chair, but I'll ask a question about your quantitative easing, Dr. DeBell. So in rough terms, I think you're about $150 billion of the way through the $200 billion QE commitment that you made. And I guess I'm asking, do you continually review the decisions you make around QE? And specifically, do you really need to do the last 50 billion? Don't you think there's enough cash in the financial system already? And whether you've had a look at what the 50 billion to come of QE, what the impact of that will be on house prices?
So yes, we do continually review. We reviewed the decision as recently as yesterday and announced the outcome of said review in our budgetary policy statement. And do we think about its impact on house prices? Absolutely. And I don't want to give away the contents of the minutes which come out in 2 weeks, but you probably see that we did actually talk about house prices, not surprisingly. And do we, and as we said yesterday, so we are, as we said in the press release yesterday, we are announcing our assessment as to what more we might want to do in our July board meeting. One thing we take account of is, absent those measures, I am very sure that we would have an exchange rate which would be materially higher than it is currently. We'd have interest rates which are higher than they are currently, and we would have an economy which would not be as strong as it is currently now or in prospect.
And ASIC Commissioner Sean Hughes said in estimates that lenders have given no indication that responsible lending obligations have clogged the supply of consumer credit. The corporate regulator has not identified any blockages in consumer credit arising from responsible lending obligations. No bank chief executives have indicated that responsible lending requirements pose any impediments in other parliamentary hearings, the Commissioner said. New loan commitments to housing rose by 5% in March and 55.3% year over year, the Commissioner noted. In addition, responsible lending obligations have also not applied to mixed purpose loans since Treasury introduced an easing provision last year.
Could I just ask ASIC, since the onset of the pandemic, has ASIC observed the current responsible lending obligations on consumer loans having any impact on the growth of credit?
Senator, I'll ask Commissioner Hughes to respond to that question, and I hope the technology allows him to do it.
Yes, thank you, Chair. Good afternoon, Senator. Senator, if I can approach your question in two ways. The first is in relation to consumer credit during the pandemic period. Of course, there was very low levels of demand for such credit, and the major focus of the banks was not in relation to new money, but rather in terms of deferrals and refinancing. So there wasn't, to be frank, a high degree of credit growth for us to measure. But in a specific answer to your question, we did not identify there being any blockages from the data that we received arising from responsible lending. And as far as I'm aware, no bank chief, in evidence which was given to the House of Representatives Standing Committee on Economics, indicated that responsible lending regulatory requirements were posing any impediments to the flow of credit to borrowers who were seeking money. The second answer to your question is in relation to small business lending. By virtue of the Treasurer's instrument put into effect last March in 2020, the provisions whereby responsible lending requirements could be imposed if there was a mixed purpose loan and the predominant purpose of the loan was for personal, such as residential purposes. That mixed purpose responsible lending obligation was put to one side by virtue of the Treasurer's instrument, and provided any part of the loan was for business purpose, even 1%, then there would be no responsible lending obligations imposed on the lender. Now, that essentially continues today. So in relation to small business lending, where any part of the loan is for business purposes, responsible lending does not apply. So as at this point, Senator, we are yet to see any empirical evidence that would suggest that responsible lending has impeded the flow of credit to consumers. And based on the data that we've seen to date, my understanding is that new loan commitments for housing rose 5.5% in March 2021 and 55.3% year on year.
Thank you, Mr. Hughes. That's helpful, and you've remarkably anticipated my next question, which was about that 55% growth in loan commitments for housing in the 12 months to March 21. Would it be fair to say that, would you agree that suggests actually a strong flow of credit?
Well, I'm not an economist, Senator, and that question may be one that would be better addressed to APRA after you see us today and to the RBA later on. All we can do is go off the data that we receive, but obviously there has been a very, very strong demand for loan finance for housing in the last few months, and that's reflected in those numbers. All I can do is reiterate that in terms of the bilateral conversations that ASIC has had with both major regional and smaller lenders, such as those represented by the ABA and by COBA, and in our discussion at an industry-wide level, we have not had any lender say to us that responsible lending obligations administered by ASIC are inhibiting the supply of credit to consumers.
All right, thank you. That's clear. Thank you for that. Can I ask whether ASIC changed its approach in any way regarding the enforcement of responsible lending obligations in light of the government's proposed abolition of those obligations?
Well, the first thing we did, Senator, was we took stock of the decision of the full federal court in the Westpac case, which we had run, and as you would be aware, ASIC was unsuccessful by a 1-2 majority in that case, to identify that our interpretation of the law was clearly not the view that was by the full court, and that the full court had sided with Westpac's interpretation. So as a result of that, we stepped back and asked ourselves, in relation to the diet of cases that we had under investigation and which we were preparing for court, whether it would be appropriate for us to proceed with those. That stocktake has essentially concluded. We do have matters that are in the pipeline that do not go to the issues that were raised in the Westpac case. But naturally, Senator, we are not blind to the realities of the proposed reforms, and we wait to see what the outcome of the government's proposed passage legislation will be. But we are not running any cases, for instance, in relation to expenditure benchmark cases that would go directly to the issues that were canvassed in the Westpac appeal.
All right, thank you. You've said you're not blind to the reality of the government's proposed reforms. Would it be equally true to say that you're not blind to the reality that those reforms are highly unlikely to make it through the Senate? And has that impacted on the way ASIC has proceeded in regards to responsible lending?
Senator, our role in relation to those reforms is to advise Treasury on the impact of those reforms on the regime, and to work with APRA so as to ensure that we are ready and stand ready to implement those reforms if they're passed. Whether they are passed or not has got nothing to do with ASIC. That's entirely a matter for government and for this chamber.
Thank you. Just last couple of questions. You may have answered this in one of your earlier responses, and if so, my apologies. I'll just ask you to respond again. But has ASIC received any feedback at all from lenders about the impact of any uncertainty regarding the future of responsible lending obligations?
Senator, I think there have been criticisms expressed in the media and by some commentators, some of whom choose to remain anonymous, that the guidance that ASIC consulted on and revised in 2019 has added complexity and uncertainty as to those obligations. In coming up with that guidance in 2019, ASIC went through one of the most exhaustive consultation processes it has undertaken in recent times. And indeed, the lengthy number of examples, case examples that we provide in that guidance were inserted at the request of the lenders themselves. That said, we are aware that there has been some perception that there is a divergence between ASIC's responsible lending guidance, and it is only guidance, it's not the law, it's simply our interpretation of the law, and APRA's enforceable prudential standards. And that is something we've looked on with some concern to make sure that that is not the case. And we remain keen to work with APRA if the reforms are enacted to ensure that there is harmony or synergy between the prudential standards which will apply to ADI lenders and how they are applied by us to non-ADI lenders. I think the other area you might be referring to, Senator, is in relation to some determinations by AFCA, which in relation to its jurisdiction, which is very different to ASIC's jurisdiction, may have created the sense that there's a further set of obligations that banks have to comply with. Again, that's something that we have discussed with AFCA to ensure that that lack of certainty is addressed. But to some extent, Senator, we need to wait to see what the outcome of the reforms are before we can take that much further.
Yeah, no, thank you, Mr. Hughes. I do appreciate that. So last question. Is ASIC aware of any lenders who are holding back on making loans, given any uncertainty regarding the future of the responsible lending obligations?
I couldn't answer that question, Senator. I do know that lenders applying a prudent banker test may well be deciding not to approve a loan because it's not a good credit risk. But I'm not aware of lenders not approving loans because of certainty about future reform.
All right. Thanks very much, Mr. Hughes, and thank you, Chair.
Thank you.
And we also heard from APRA that the only change the removal of responsible lending obligations would be a change in timings to their upcoming guidance. It has no material impact, which begs the question, given the high risk, high home lending growth that we're seeing, should responsible lending obligations be removed? Well, the government's planned repeals to the responsible lending obligations under the National Consumer Credit Protections Act 2000 are due to be voted on when the Senate meets in mid-June. The bill, which Treasurer Josh Frydenberg has stayed firm on, has seen growing opposition from crossbenchers, the most recent being Tasmanian Senator Jackie Lambie. One Nation leader Pauline Hanson and Independent Senator Rex Patrick have also indicated that they will not support the bill, while consumer advocate groups such as Choice have also voiced their disapproval for the repeal. What I want to do is to highlight once again the Ponzi scheme that Shane Wright called out, and highlight again the importance of having responsible lending obligations which protects consumers from lenders that are too willing and able to lend at the moment, thanks to the very low rates of funding from the RBA through the Term Funding Facility, and the quest of banks to lift their profits because home lending is the only game in town. And with the Reserve Bank still believing that the wealth effect is the critical thing and low levels of unemployment is the main objective, never mind what happens to house prices, this could definitely continue for some time, but it is not right. It's not just. And the rising inequality that we're seeing, which comes through very strongly in my data and in other surveys too, is the leading indicator of significant trouble ahead. And of course, reflect on this: what happens when interest rates start to rise, as they will, even out of cycle, as I discussed the other day. So this Ponzi scheme will pop. It's just a question of timing. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.